As we all know, mortgage interest rates have changed a lot in this past year. It has been unpredictable, but suffice to say, rates are high. Now, what does that mean for you? It impacts both buyers and sellers, so let's talk about it, both sides. This is a part of a short series I'm doing relevant to the 2023 real estate market, so I'm keeping it relatively short in context. I hope you'll stay with me, and if it's relevant to you, please subscribe, share, comment. Let's get into it. What's up? My name is Joshua Smith. I'm with the Home Agent Group. I want to talk to you about what you're up to and how we can expand together.
To be honest with you, and you can cut this if you need to.
It's the highlight of our entire trip.
And when budgeting for your new home, it's a good idea to think like the bank. If you have not already, you want to go ahead and get pre-approved or pre-qualified for the home loan. This will walk you through the process of a loan application, which also checks off one of those many boxes that you have to check off when you go to purchase if you need to borrow money. But this also will help you understand what the qualifications are. Beyond just a good credit score, you have to keep a low enough debt to income ratio, and that ratio is going to weaken as the monthly payments for your new home loan go up. Basically, they look at your existing monthly credit debt versus your existing income to know how much you can spend per month. Interest rates are one of the ways that the monthly payment will go up, so all this information that you get from your lender is exactly what you need to know when budgeting for your purchase. Now, of course, you need to save money for your down payment, and the better you are at saving and keeping your credit debt low, the better your chances are of getting approved. But once you are approved, this tells you how much money you can spend on that new home. When I say think like the bank, what I mean is that if you're approved to spend $500,000 based on your pre-approval, you can't be looking at $600,000 homes. You need to stay inside the budget that the bank gave you. But also, as you look, if you have the ability to pay down certain debts to reduce your debt to income ratio, well, this is going to help increase how much you can spend. There are ways that you can directly combat the interest rate as well. When I'm searching with buyers that I work with, I always suggest padding our budget number by a little bit. And I do that for a couple of different reasons. One is that if a property's been sitting a while, the sellers may be willing to come down on the list price to encourage the sale. Another is that whether or not they want to come down on the price, they are likely to be accommodating to other concessions, which also involve some money exchange, like paying your rate down or paying for other closing costs that can help you stay within that monthly budget. So most banks have what's called a 2-for-1 buy down available these days. This is when the seller agrees to pay a fee up front that allows the buyers to get 2 points off their first year, 1 point off their second year, and on the third year, the rate goes up to what they qualified for. To use our current example, on a $500,000 purchase, this can reduce that monthly payment by as much as $500 per month in the first year, $250 in the second year. Also, there's typically no prepayment penalty and no penalty to refinance for a better rate if the market rates do come down within those 3 years. But the other option that you always have is to buy down points from your rate permanently. This is costly, but might feel a little bit more secure if you're not confident that rates will drop in the next 2 to 3 years. A seller can buy that, a buyer can buy that at closing. A good agent will be able to help you find out what a seller is willing to do to help make that sale happen. And you don't want to feel left out of an opportunity when they're out there. Now, this last point does bring me to one last thing, and that is how all of this can affect sellers. I'm seeing sellers and listing agents catch up to this as the year has trucked on, but what I just described is a good reason to make sure that you are not overpricing any property on the market. Most of the properties in the markets that I work in both Alabama and Tennessee haven't seen any tangible reduction in value, so there's no reason to think that your house isn't worth the same as neighbor Jerry's that sold for that crazy price, as long as Jerry's house looks like yours, has the same updates and upgrades and level of maintenance, because that's how you know how much your house is worth. Comparable sales close by that happened recently. If you price the house according to the market, you're much more likely to get what you expect and to sell sooner than later. This also affords you more leverage when being asked for concessions that'll eat into your bottom line. there will more than likely be fewer reasons for buyers to ask for more from you if you're not overpriced and as such haven't sat on the market for too long. Now, in some places it can just take a little bit longer to sell, that's fine, but pricing is the main thing that will dictate the offers that you get whenever they come. Obviously, there are more intricacies to dig into in this arena. I have other tips and market info on the channel, so feel free to comb through and see more. But I hope that you enjoyed this one and will tap that notification bell or subscribe to see more videos like this one in the future and others when I can get into a little bit more detail. I thank you for watching, and I'll talk to you soon.